This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 131, operating activities. Primarily derived from the principal revenue-producing activities of the entity. They generally result from the transactions or other events that enter into the determination of net profit or loss. Amount of cash flows arising from operating activities is a key indicator of the extent to which the operations of the entity have generated enough cash to repay loans, maintain the operating capacity, pay dividends, and make new investments without having to rely on external sources of finance. Investing. Cash flows included here are those related to the acquisition or disposal of any non-current assets or trade investments. Shows the extent of new investment in assets which will hopefully generate future profit and cash flows. You generally work on the principle in the exam. Just go back a page. Just look at page 130. Just count the number of figures in those last columns. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, an additional one for share premium, 18, 19, 20, 21, the bottom three figures. It's basically 1 mark for every correct figure. Work on the principle of 1 mark for every figure you get right. Some of them were given in the question. You may very well find profit on disposal of assets or loss on disposal. And you certainly find either that or you'll find the proceeds of disposal. You might have to calculate depreciation. You might have to calculate how much has been spent buying new assets. But some of these 20-odd figures will be given to you. Some of them are really easy, like the add-back of interest, the add-back of depreciation, the add-back of investment income. Some of them you have to calculate. Tax paid, dividends paid, interest paid. You might have to calculate. Changes in working capital. What was the inventory last year? What is it this year? What's the change? So some of them are really, really easy. Incredibly easy. Work on the principle of 1 mark per correct figure. When you get to property, plant and equipment, when you get to TNCA, TNCA affects us in 4 ways in a cash flow statement. There's the add-back of depreciation. There's potentially an add-back of the loss on disposal. And then within investing activities, there's proceeds of disposal and also money spent buying new assets. So TNCA potentially is quite a rich earner. It's 4 marks potentially. And 4 marks is how many minutes, Gatis? 12? Good Lord. That's 300 minutes. That's a 5-hour exam you're doing. 4 marks is how many minutes, Natalie? Were you here yesterday?
Yes.
Were you listening yesterday?
Yes.
Olga, how many is 4 marks? Minutes. 10. What's 4 times 2? Altogether, 4 times 2, 8. Take off 10%. 7.2. God. 7.2. It's potentially 7.2 minutes worth of effort on TNCA. But not more. Because there are so many other easy marks that if you spend longer, you're going to lose the opportunity of scoring the other easies. Example 1 there. We've got Danguola. It's got property and depreciation. So we've got some more property at the end of the year. And we're told that she had an item of plant was sold, it had originally cost that, had a book value of that, property was that, and that. Can you show the relevant entries? Can you work out the 4 figures necessary for Danguola? Just imagine these assets. Just imagine this property, plant and equipment. Can you just close your eyes for a moment and just picture this property, plant and equipment? Have you got it? Are you there? Okay. Roll forward. 960 cost, 390 depreciation. And some of this assets have been sold. They originally cost 110. They had a book value of 40, so 70 has been sold. 70 depreciation. That's the 40,000 book value. And we've realized a profit on disposal of 7, and we've got proceeds of disposal of 47. So that deals with the one that we've sold. And that means that I started and I still have 850 assets, and they have accumulated depreciation of 320. So the assets that I started with and I still own are those, 850, depreciation 320. But some of these assets I've revalued. They did have a value included within that 850. They had a value of 100, and I've increased that by 250 to 350. So now the assets which I started with and I still have got a cost value or revalued amount of 1,100 with depreciation still of 320. That's technically not correct, and the reason it's technically not correct is that the revaluation really should be an adjustment to the depreciation. But I don't know how much depreciation was on that 100,000. So revaluation is what you're saying is I've depreciated it too much, so I'll undo the depreciation and then revalue it even higher. Technically it should go against the depreciation column, but we don't have the information. So that's what I'm expecting to see in the statement of financial position at the end of this year. That's what it should be. So if we look at the carry forward figures, we'll see 1320 and 520. So there's a difference of 220 there and a difference of 200 there. Well, this must be this year's depreciation. And this must be cost of new assets. Financing, page 132. Cash flows here relate to the way in which the entity has increased or decreased its capital base by way of share issue or borrowings, or by repaying loans and obligations under finance leases. Financing cash flows comprise receipts from or repayments to external providers of finance. In order to calculate the figures, the closing, I'm going to use the word because it's easier, the closing balance sheet is compared with the opening balance sheet. That gives you the movement in the year. The effects of any non-cash flow changes to share capital, for instance, bonus issues. Not covered this, we've not looked at earnings per share, we will do on the revision course. But earnings per share is affected by, as a topic, it's affected by bonus issues. A bonus issue is where the company gives its shareholders additional shares. I'll show you very briefly, just as a digression away from cash flows, just very briefly. If we've got shares of 300,000 and we have a share premium of 150,000, maybe a revaluation reserve of 100,000, and retained earnings of 200,000. So shareholders' funds are therefore 750,000. The apparent value of those shares is $2.50, isn't it? The apparent value of those shares is apparently $2.50 each. Net assets are worth 750. There are 300,000 shares. 300 into 750. Apparent net asset value of $2.50. Now what I'm going to do is I'm going to give you some additional shares. I can finance this. I can finance it from retained earnings. I can do, but that actually will be grossly inefficient. Those of you who remember your law studies will remember that there are very, very few uses of the share premium account. There are only 4 uses of the share premium account, and one of them is to finance the issue of fully paid bonus shares to existing members. So what I'm going to do is, I'm going to say that for every 3 shares that you own, I'm going to give you 1 new one, an additional one. So instead of owning 3 shares, you're going to have 4. And I'm going to give this to you. Don't want you to pay me any money. I'm going to give you an additional share. Now, how generous is that? Hey, come on, that's not bad, is it? You did have 3 shares, now you've got 4. That's not bad. And the double entry I'm going to put through is I'm going to increase that by 100,000. For every 3 you did have, you now have 4. For every 300 you have, you've now got 400. For every 1,000 or 300,000 you had, you've now got 400,000. Don't pay me any money. I don't want money. I don't need it. Because what I'm going to do is I'm going to deduct it from there. You'll notice I've not affected the revaluation reserve. I've not affected the retained earnings. And so the net assets of this company are now 750. So tell me, what have I given you? I've given you something that was already yours. What I have done is I've changed your share value. Your shares are now worth 187.5. They're no longer worth $2.50. They're now worth 187.5. Hey, but you've got 4 of them instead of 3. All right? Bonus issue. No money changes hands. But what does change is the shares and possibly the share premium. May not be share premium. I could have done this by taking 100,000 out of retained earnings. Or a general reserve. If there had been a general reserve, I could have financed this issue of fully paid bonus shares out of the general reserve. So you need to be careful how you read the question. But we've got Irita here. Irita's got equity share capital and share premium account. And during the year, she made a 1-for-7 bonus issue. What I've done there is a 1-for-3 bonus issue. For every 3, I've given you 1. Irita's having a 1-for-7. For every 7, she's going to give a free one. So can you tell me what are the proceeds of sale from the issue of shares? She had an issue of shares in December. What were her proceeds of sale? Okay, that's how we start. And there it is going to give a 1 for 7. For every 7 you already have, here it is going to give you 1 more. So how many new shares is she giving by way of bonus issue? 5,000. This will increase the share capital by 5,000. Where's that 5,000 coming from? It's not coming from the share premium account. Irita has been badly advised. It should, if she had been well advised, it should be coming out of share premium. But there's a general reserve with, say, 16,000 in it. Say. And this 5,000 is being financed by capitalizing the general reserve. She's been very silly, as Irita. Any sensible advice, any sensible merchant bank or financial advisor or accountant would have said, don't take it out of general reserve, take it out of share premium. But no, she's gone ahead and done it from general reserve. So now she's got 40,000 shares in issue, and she still has 17,006 in a share premium account. And she's got, say, 11,000 in general reserve. But we know from the balance sheet at the end of the year that she actually has 58,000 shares and 29,007 share premium. So she must have had a new issue of 18,000 shares at a premium of 12,100. Proceeds are therefore 30,100 within financing activities. Now let's assume that you've calculated something wrongly. Let's assume you've got, don't do this, let's assume you've got that to be 11,100 in your workings, in your head. You've got that to be 11,100. So you're going to put here 29,001. And the marker can't see any of that. All you've got is proceeds of share issue 29,001. How many marks are you going to get for that? You only made one mistake. It's only a silly mistake there. But he doesn't know what mistake you've made. No idea. So in fact, you could very well lose everything there. There's 2 marks for this. One for the shares, one for the premium. So in the exam, please do this. Please put 18 plus 11.1 wrongly. Or proceeds of shares, 18. Premium on share issue, 11.1. Either way, show the marker where your figures are coming from. We did it all the time with consolidations. Every figure, apart from share capital, every figure on the consolidated statement of financial position, I showed where that figure had come from. So when you're doing this one, and it is 30,100, when you're doing this, can you show the makeup of the figure, where it's arrived from? That's here, it's sorted out. Example 3, interest paid. Agnes. In her payables, she's got some accrued loan interest. In the comprehensive income, we've got 217,000 shown. No bank loans, no overdrafts. She's entered into a finance lease during the year. The total payments to the finance lease creditor were 9,000, of which 1,800 is interest. She's put the full 9,000 in the obligations on the finance lease account. Can you prepare the relevant extracts from Agnes' statement of cash flows? It seems to me there's a lot of logic in this. What's the income statement interest charge? This should not be a problem. All right? The income statement interest charge is 217. Yeah? So that's the add back, 217. It's an accruals-based figure. It's the interest which relates to the year. But it's not the interest which is paid. That's the interest which relates to the year. So that needs to be added back to our profit before tax. Now, interest paid. That interest charge includes some interest which we've not yet paid. And when we paid interest, we didn't just pay interest for this year, we've also paid some interest for last year. And it seems to me it comes down to another little chant that you can sing to yourselves. The brought forward liability was 74. The income statement charge is 217. So that gives me a total of 291. And if I deduct from that the carry forward liability, that gives me 273. And that must have been paid. In T accounts, the brought forward liability, 74. The income statement charge, 217. Debit the income statement, credit the account. I've got a carry forward liability of 18. Therefore, I've got a missing figure there. That must be 273, and it must be cash. Can't be anything else. And the little chant you can call to yourself is this, because it works not just with interest, it works with investment income, it works with taxation. It works in a number of situations. The little chant would be brought forward income statement, carry forward cash. Just say it yourselves. Brought forward income statement, carry forward cash. Brought forward income statement. Do you feel yourself moving? Brought forward income statement, carry forward cash. Do you feel yourself getting in the brought forward income statement? No? Say? Still H's own. You can't beat H's own, can you? Brought forward income statement, carry forward cash. You think of it. in terms of a U. Brought forward income statement, carry forward cash. So, 273 is paid, but we've also got this payment to the finance lease creditor wrong as well. So there actually is another 1,800 to add on to that. So actually interest paid is 274.8. And then finally, in financing activities, we've got a payment to the finance lease creditors. Oh, please tell me you didn't get that one wrong. Please tell me you arrived at the right figure for that. Helena. Yeah, it's 7,200. Can you just speak up a bit? 7,200, isn't it? We've recorded it as 9,000. But I told you when we were going through the pro forma that it's only the capital payments. The finance lease creditor, if you think about it, it's just the capital amount outstanding. The interest is not recorded until it's actually accrued. Then we accrue the interest and then we pay it. So in the finance lease creditor account, there's only the capital amount outstanding. So it's only the capital amount, the 9,000 minus 1,800, that should have gone there. So payments to finance lease creditors will be 7,200. I don't think I checked everyone, but certainly everyone I did check was right. The brought forward liability is 420, then that's increased by this year's tax charge. So if we had paid all our taxes up to date, we would have paid 820. But we know that we've not paid 390 of it, therefore we have only paid 430. So brought forward 420, income statement 400, carry forward 390, means that I must have paid 430. Brought forward, income statement, carry forward, therefore cash is 430 payment. If you want it in T-account format, we have a brought forward liability of 420, an income statement charge of 400, we have a carry forward liability of 390, which is brought down into next year, 390, and the missing figure is therefore 430 cash. Brought forward income statement, carry forward cash. Okay, let's have a look then at Deauville. Can you tell me how much dividend was paid by Deauville in the year? I think you all got 1431, didn't you? There's a couple of nasty little tricks in this one. The first one is most unusual. It's normal that you would expect the earlier year to be in the right-hand column. This time it's reversed. He's done it once. Only once, as many years ago. You put 2003 or 1925 or whatever, you put it in the left-hand column, put 1926 in the right-hand column. You'd normally expect it to be the other way around. You'd normally expect the earlier year to be on the right and the later year on the left. That's trick number one, which is a bit naughty. So your brought forward is 831, not 915. And the other nasty little trick is this one. What do you think happened to that 831 liability last year? Well, let's say that nothing happened at all. All right, I brought an 831 liability forward, and then in May, I say, oh, here's an interim dividend in respect of this year. Here's a dividend halfway through this year of 600. Are you not going to write back to me and say, but you promised me 831 at the end of last year in respect of last year's dividend? What happened to my 831? Why are you only paying me 600 for this year when you've still not paid me 831 for last year? That 831 must have been paid. It must have been paid. In T account format, it would look like that. And we brought down liability of 831, and then we've declared a dividend of 600. This is a dividend payable account. We've declared a dividend of 600 for the interim period. And we've also declared a dividend of 915. The final dividend, we've proposed it before the year end. It is an obligation we have raised in the minds of those affected, the valid expectation that they will receive a 915 dividend, but we'll pay it to them next year. So it's an obligation at the end of this year. Below the double lines on the right-hand side is a liability on the balance sheet. Below the double lines on the left-hand side, it will be an asset on the balance sheet. So there's the obligation according to the balance sheet. It must have come from somewhere. It comes from up here. Brought down, carried down. It's just the balance on this account. So I did have an obligation of 831, which I've paid. I created an obligation of 600, which I've paid. I've created another obligation of 915, which I have not yet paid, so it still exists as an obligation. Very few students get that right. Very few. But you'll get it right now. It's the first time you've seen it. Can't be expected to be wizards and witches at the early stage. Witches maybe, not totally, utterly on top of your broomstick. Okay.